Hi guys, today we're going to cover what is a stock. So have you ever heard the term stock and wondered what it really means? Well, let's envision a company and let's call it Hypothetical Solutions Limited and say this company designs gadgets for the future. Now imagine if Hypothetical Solutions Limited wants to expand and build a new factory. Well, they need to generate money for that, right? And one way they could get that money is by selling parts of the company to the public. And these parts of the company are what we call stocks or shares. And when you buy a stock, you're essentially buying a small slice of a larger pie. You become a shareholder, own part of Hypothetical Solutions Limited, and as you own part of the company, you're entitled to have a say in how it's run, and you will receive voting rights proportional to the number of shares or stocks that you own. So why would you want to buy a stock? Well, there are two main reasons. The first is dividend income. Some companies will release a portion of their profits each year to their shareholders in the form of dividend payments. These are not guaranteed, and it really depends whether the company wants to release the income or not. There's also appreciation, because if Hypothetical Solutions does well, the value of your stock might increase. So you could sell your stock for more than you bought it for, making a profit. But just remember, just as a company can succeed, it can also face challenges. If Hypothetical Solutions Limited doesn't do well, the value of your stock could decrease. And investing in stocks always comes with risks. And one question you might ask, if I'm buying to sell at a higher price, well, what drives the value of the stock? And at its core, stock prices are determined by supply and demand. If more people want to buy more stocks than people are willing to sell, then the price tends to move up. Conversely, if more people want to sell a stock than buy it, the price tends to move down. If Hypothetical Solutions Limited announces a revolutionary new product in their stock, that can also increase the price. However, if they face a lawsuit, the stock might decline. Company news is really important. And company earnings reports, leadership changes, or mergers can also play pivotal roles. Typically, if a company also has higher profits, it should increase in value. And broader economic news like changes in employment rates, inflation, or central bank policies can influence the overall mood of the market. For example, a strong economy often boosts investor confidence, potentially driving stock prices up. And remember, stock prices aren't isolated bubbles. Political unrest, wars, natural disasters, or even pandemics can shake investor confidence and impact stock prices. And when interest rates rise, borrowing money becomes more expensive, which can reduce company spending and earnings. And this change can lead investors to sell the stocks. Conversely, lower interest rates can stimulate stock buying. And sometimes it's the perceptions and the predictions of investors that drive stock prices. If traders believe a stock will go up, they buy, driving up the price, even if there's no news about the company. However, even when there is good news for a company, if speculators had assumed there would be better news, well, the price can often fall. If a company increases profits by 100%, but the market expected profits to increase by 200%, it's likely the price will drop on the 100% news. And sometimes people just like irrational reasons, like the name of a company, to buy it. When Long Island Iced Tea changed their name to Long Blockchain Corp in 2018, shares jumped 200% in value the day it was announced. And though illegal, there are cases where stock prices are artificially inflated or deflated by those looking to make a profit. Now, there's regulatory bodies in place to monitor and act against such activities, but they can still influence prices, at least temporarily. All of these factors and more impact stock prices. Investing in stocks is considered to be higher risk due to the unpredictable nature of stock prices. The flip side is when compared to more predictable investments like bonds, over the long term, stocks tend to yield higher returns. So just to sum up, a stock is a piece of a company you can buy. You can make money through dividends or selling the stock at a higher price. However, remember, stocks come with risks and their value can go up or down in a rather unpredictable fashion. That's a quick overview of what stocks are. Investing in stocks is a vast topic with many nuances, but understanding the basics is the first step. If you're considering investing, it's a good idea to consult with a financial expert first. And if you're looking for help for long-term financial planning, click the link in the description for a complimentary call with a Black Tower advisor, such as myself. I've been Luke Staden. I hope you've enjoyed the video, and until next time, take care.